$1. That is all it takes to trigger an extra $1,000 in Medicare premiums for a full year. You sell a rental property in December. Good year. A significant taxable gain, the kind that looks fine on paper. Then, 14 months later, your Medicare statement arrives and the number does not look right. You're paying close to $80 a month more than your neighbor, who retired on the same day you did. Maybe you missed the notice when it arrived, or maybe the letter did not explain what triggered it. That taxable gain from the property sale 2 years ago lifted your MAGI over the Medicare threshold and pushed your Part B premium into the next bracket. For the entire year, that is IRMAA, Income-Related Monthly Adjustment Amount. When two Medicare-enrolled spouses in the same household cross that first threshold together, the extra Part B cost alone runs nearly $2,000 more per year, and that is before counting Part D drug coverage. For a single filer, that first tier adds close to $1,000 more per year in Part B. When you add Part D surcharges on top, the single filer total at Tier 1 reaches roughly $1,150 more per year. $1 of MAGI over the line. I help retirees understand the retirement tax rules that nobody walked you through before you left work. In the next 15 minutes, I will show you exactly how this surcharge works, which income sources trigger it, the 2026 thresholds you need to know, and 4 moves that may help you avoid or reduce the surcharge. And in Part 5, I will tell you about the appeal process that most people do not know exists, because sometimes IRMAA hits you when it should not, and you can push back if your situation qualifies. Stick around for that one. Here is what we are covering today. Part 1. What IRMAA actually is and why most retirees never see it coming. Part 2. The 2026 income brackets and the main dollar jumps at each threshold, covering both single tax returns and the married couple joint return. Part 3. The income sources that count against you, including the one that surprises most people. Part 4. 4 concrete strategies to avoid or reduce the surcharge. And Part 5. What to do if you get hit with IRMAA and you think it was a mistake, because there is an appeal process and it works. One thing before we start. The numbers I will share are the 2026 figures, and they are based on your 2024 tax return. That 2-year delay is built into how the system works, and it is exactly what catches most people off guard. We will cover why that matters in Part 2. Part 1. What IRMAA is and why most retirees never see it coming. IRMAA stands for Income-Related Monthly Adjustment Amount. It is the extra charge that higher-income Medicare beneficiaries pay on top of the standard Part B and Part D premiums every single month. Not a one-time fee. Not a deductible. A monthly surcharge that shows up in your Social Security check as a deduction, 12 months a year. The standard monthly Part B premium in 2026 is $202.90. That is the number most people hear about. That is what roughly 92% of Medicare enrollees actually pay. But if your income crosses certain thresholds, that number goes up. Not a little. In some cases, it triples. Medicare added IRMAA back in 2003 as a way to have higher income beneficiaries pay a bigger share of the program's cost. It started applying to Part B in 2007 and was extended to Part D drug coverage in 2011. So this is not a new rule. It has been around for nearly 2 decades. But a lot of retirees are still blindsided by it, for one simple reason. The surcharge is calculated based on your income from 2 years ago. So in 2026, Medicare is looking at your 2024 modified adjusted gross income. Not your current income. Not what you made last year. What you made 2 years ago. If you had a higher income year in 2024, for any reason, a property sale, a large IRA withdrawal, a one-time bonus, Medicare is going to charge you for it in 2026, even if your income today is much lower. That 2-year lag is the reason people get surprised. You retire in 2025. Your income drops significantly. You assume your Medicare premium will reflect your new, lower income. Instead, you open your first Medicare statement and discover you're being charged based on the income you earned while you were still working full-time. That is a real shock, and it happens to thousands of retirees every year. Part 2. The 2026 brackets and what the dollar jump looks like at each threshold. This is the part of the video I want you to take notes on, or at the very least, screenshot when it appears on screen. These figures come from the 2026 Medicare Part B and Part D IRMAA tables published by CMS and Social Security. One important note before we start. If you are married filing separately, the brackets are sharply different and much less favorable. The income thresholds for married filing separately filers are far lower than what I will cover here. Do not assume the single filer or joint filer numbers apply to your situation if you file separately. Check the Social Security IRMAA schedule directly. Here are the income thresholds for everyone else based on your 2024 modified adjusted gross income. If your 2024 MAGI was $109,000 or less as a single filer, or $218,000 or less. If you're married filing jointly, you pay the standard Part B premium of $202.90 per month. No surcharge. The large majority of Medicare Part B enrollees pay this standard amount. IRMAA affects the higher income minority. Now the first bracket is where the cliff lives. Cross $109,000 as a single filer, and your premium jumps to $284.10 per month. That is an increase of $81.20 per month, or nearly $975 per year. $1 over the line. 1 full year of that surcharge. Now, the next 3 brackets are where the premium starts to bite harder. If your income is above $137,000 as a single filer, or above $274,000 as a couple, your monthly Part B premium rises to $405.80. Think about that for a moment. The standard premium was $202.90. You are now past twice that. Above $171,000 for a single filer, above $342,000 for a couple, the monthly premium goes to $527.50. Every month. Above $205,000 for singles, above $410,000 for couples, you're at $649.20 per month. That is over $300 more per month than the standard rate. Per person. The top bracket is where this becomes painful. At $500,000 or above for a single filer, $750,000 or above for a couple, the monthly Part B premium is $689.90. That is more than 3 times the standard $202.90 premium. And remember, this is a monthly charge for the entire year, not a one-time fee. Now, here is the number I want you to sit with. The gap between the standard premium and the first surcharge tier is about $81 per month, but the gap between the standard premium and the top tier is $487 per month. Per person. If you are a married couple, both on Medicare, that top-tier gap is $974 per month extra, nearly $11,700 per year. And here is the cliff that the title of this video is describing. If your 2024 MAGI came in at exactly $109,000 as a single filer, you pay the standard $202.90. If your income came in at $109,001, $1 over the line, you owe $284.10. every month. For the entire year, $1 triggered nearly $975 in extra Medicare costs for the year. Here is the question that should be running through your head right now. It is not just how much income you have. It is which dollar pushes your Medicare over the cliff. That is the frame for everything in Part 4. Part D drug coverage works the same way, with its own set of income-based surcharges stacked on top of whatever your plan premium already is. For 2026, the first tier adds $14.50 per month. The second tier adds $37.50. The third tier, $60.40. The fourth tier, $83.30. And the top tier, $91 per month. Again, per person, per month, on top of your regular Part D plan cost. So when you add Part B and Part D surcharges together, crossing that first income threshold as a single filer costs you roughly $1,150 per year in additional Medicare premiums. That is about $96 more every month. Cross the second threshold, and you're looking at nearly $2,900 more per year. In a two-person household with both partners enrolled in Medicare, those numbers double. These are not small amounts for a retiree on a fixed income. If those numbers feel like a lot to absorb, that is okay. You do not need to memorize every bracket. You only need to know the one threshold just above where your income actually lands. That is the number that matters for your planning. Part 3. The income sources that count, and the one that surprises most people. When Medicare calculates your IRMAA, it uses your modified adjusted gross income. That is your adjusted gross income, plus any tax-exempt interest you received. Here is what gets counted toward that number. Traditional IRA and 401k withdrawals. Every dollar you pull out of a pre-tax retirement account shows up as ordinary income and counts in full. Pension and annuity income. If you have a pension or an income annuity paying you each month, that counts. Capital gains. If you sell a rental property, stocks, or any other investment at a gain, that counts, even if it is taxed at the lower capital gains rate. Wages. If you are still working part-time or consulting, your wages count. Social Security income. A portion of your Social Security benefit may be taxable, and that taxable portion counts toward your MAGI. Required minimum distributions. Once you reach the age when the IRS requires you to pull money from your traditional retirement accounts, those forced withdrawals count in full, even if you do not need the money and would have preferred to leave it alone. Now, here is the income source that genuinely surprises most people. Tax-exempt municipal bond interest. If you own municipal bonds because you heard they were tax-free, you are right that they avoid federal income tax. But they are still counted in your MAGI for IRMAA purposes. They are added back in. So a retiree who holds a significant municipal bond portfolio and thinks they have structured tax-free income may still cross an IRMAA threshold because of those bonds. Here is what does not count toward IRMAA income. For most retirees, taking qualified Roth IRA distributions, meaning the account has been open at least 5 years and you are over 59 and a half, those withdrawals do not count toward your MAGI. Roth rules can get more involved if you have recent conversions, so verify the 5-year rules before relying on this. But the basic principle holds. Money you already paid tax on when you put it in the Roth is not taxed again as MAGI when you take it out. That advantage becomes relevant when we talk about strategies in Part 4. Certain distributions from cash value life insurance policies, structured properly, may also not count. But this is a narrow planning area that only applies if you already own that type of policy and a qualified professional has reviewed how your specific policy works. Do not treat this as a reason to buy a policy. One more thing before we get into strategies. Strategy 3. In Part 4 is the one most people overlook. It can solve a future IRMAA problem, but if you do it wrong, it triggers a new surcharge right now. I will show you exactly how to thread that needle in a few minutes. Part 4. 4 concrete moves to avoid or reduce the IRMAA surcharge. Now that you understand how this works, let's talk about what you can actually do about it. I am going to give you 4 strategies, from the simplest to the more involved. Not every one of these will apply to your situation, but understanding all 4 helps you have a much sharper conversation with your financial planner or tax advisor. Strategy 1. Know your MAGI number every year because it determines your Medicare premium 2 years from now. This sounds simple, but many retirees genuinely do not track their MAGI on an ongoing basis because the surcharge is based on income from 2 years ago. The income year that matters for 2026 was 2024. The income year that matters for 2027 will be 2025. If you pull your 2024 tax return and find your adjusted gross income, add back any tax-exempt interest and compare that total to the thresholds I just covered, you already know whether you are paying a surcharge this year. And if you are within striking distance of a threshold, you know to be deliberate about your income in the current year. Strategy 2. Be deliberate about when you take large one-time income events. This is where the IRMAA cliff creates real planning opportunities. If you're thinking about selling a rental property, converting a large amount from a traditional IRA to a Roth, or taking a significant capital gain, the timing of that event affects your Medicare premium 2 years later. A large income spike in 2025, for example, will show up in your 2027 Medicare premium. 1 year of elevated income, 1 future premium year affected. If you have flexibility, spacing those events out over multiple years, each one staying below the relevant threshold, can save you significantly. Here is a simple example. Say you need to convert $40,000 from your traditional IRA to a Roth. If you do it all in 1 year and it pushes your MAGI to just over $109,000 as a single filer, you owe an extra $975 in Part B surcharges that year. If you split it across 2 years, $20,000 each, and stay under the threshold both years, that extra surcharge never hits. Same total conversion goal. Potentially a very different Medicare bill. The timing was the only variable. Strategy 3. Roth conversions as a long-term IRMAA shield. This is the strategy that connects most directly to long-term Medicare cost planning. Every dollar you have already moved from a traditional IRA into a Roth account is a dollar that will not appear as taxable income when you withdraw it in retirement. And that means it is a dollar that will not count toward your MAGI for IRMAA purposes. Retirees who did systematic Roth conversions in their late 50s and early 60s before Medicare kicked in, converting at lower tax rates during their income gap years, often find themselves with a much more manageable MAGI in their 70s when their required minimum distributions begin. The RMDs from their remaining traditional accounts are smaller. Roth distributions do not count, and they stay comfortably below the IRMAA threshold. The window to do this most efficiently is typically between retirement and age 73, when required minimum distributions begin for those born between 1951 and 1959, or age 75 for those born in 1960 or after. That gap is often the lowest income period of a retiree's life, and it is the prime time to convert. But here is the caution. A Roth conversion can solve a future IRMAA problem while creating a current one. Every conversion dollar adds to your current year income, which affects your IRMAA premium 2 years from now. You want to convert up to just below the threshold, not over it. The conversion amount matters more than the idea. This requires knowing the thresholds, doing the math ahead of time, and revisiting it each year. Strategy 4. Qualified charitable distributions. If you're over age 70 and a half, you can transfer money directly from your traditional IRA to a qualified charity. This is called a Qualified Charitable Distribution, or QCD. The IRS indexes the annual QCD limit. Check the current year figure on irs.gov before acting, because it has increased in recent years as the law is inflation adjusted. The money goes directly from the IRA to the charity and never appears in your adjusted gross income. Once you are subject to RMDs, a properly executed QCD can count toward that year's RMD while staying completely out of your adjusted gross income, which means it does not push your MAGI higher. For retirees who are charitably inclined and also facing IRMAA pressure from their RMDs, this is one of the most powerful tools available. Instead of taking the RMD as income and then donating from your checking account, you donate directly and the income never counts. Part 5. What to do if IRMAA hits and you think something has changed? We have covered prevention, but what if the letter already came? That is what Part 5 is for, and I promised you this one at the start. Most retirees do not know this process exists. If your income has dropped significantly since the year Medicare is using to calculate your surcharge, you can appeal the determination. Social Security administers IRMAA, and it has a formal process called a life-changing event appeal. You fill out a form and provide documentation showing that your current income is lower than the income being used. The qualifying life-changing events are specific. They include retirement or reduction in work hours, the death of a spouse, divorce, loss of income, producing property from circumstances outside your control, loss of pension income, and receipt of an employer settlement related to a bankruptcy or reorganization. Retirement or reduced work can qualify. But Social Security will still look at your new estimated income, including any investment income you continue to receive. So if you retired but still have significant dividends, rental income, or RMDs coming in, the surcharge may be reduced rather than eliminated entirely. A one-time capital gain by itself, a property sale, a large IRA withdrawal, does not automatically qualify as a life-changing event. The appeal process is designed for genuinely changed circumstances, not just for income that happened to be unusually high one year. If your appeal is approved, Social Security will use your current or more recent income instead of the 2-year-old figure. The process takes time, but it can save a meaningful amount of money if your situation genuinely qualifies. One more thing I want to flag here. Sometimes the IRMAA determination contains a data error. Social Security relies on IRS data, and occasionally the wrong tax year gets used or the wrong filing status is applied. If the year or filing status in your determination does not match your actual return, that is the basis for a review. You have the right to request a correction, and you should. This is why a one-time income spike is not always appealable, but retirement itself, or a major life change that permanently reduced your income, often is. Those are two different situations, and knowing which one you are in is the first step. Let me bring this full circle before we close. IRMAA is not punishment for being financially responsible. It is a feature of the Medicare system, and it is completely manageable once you see it coming. The retirees who get hurt are the ones who did not know the thresholds existed or who made a perfectly reasonable financial decision, sold a property, took a large IRA withdrawal, did a Roth conversion, without realizing that the Medicare bill would show up 2 years later. The one thing I want you to walk away with is this. Your MAGI today determines your Medicare premium in 2 years. It is not just how much income you have, it is which dollar pushes you over the cliff. Once you understand that, you can plan around it. Pull up your 2024 tax return. Look at your adjusted gross income. Add back any tax-exempt interest. Compare that number to the thresholds we covered today. That one exercise will tell you exactly where you stand. This information is education and not financial advice. Your situation has details that no video can fully address. Walking through this with a qualified fiduciary or tax professional is the right move, especially if you are close to one of those thresholds or planning a large income event. In the comments, type the word cliff. If you want me to go deeper on any part of this, including how Roth conversions interact with Social Security taxation at the same time, those two forces together create something people call the tax torpedo, and it is worth its own breakdown. If this helped you see something you had not seen before, hit like. It helps other retirees find this when they need it most. And subscribe so you do not miss the next one. Because the tax rules of retirement were not designed to be obvious. They were designed to be followed. The difference between the retirees who pay the extra $2,000 and the ones who do not is usually just one number they knew in advance. That is why we are here. I will see you in the next video.